Hey everybody, just wanted to give a quick hello. I don't show my face that much on this channel, but I just wanted to give it a special thanks to everyone lately that's been sharing the videos and commenting. It's been helping the views, so the views have been picking back up a little bit, so thank you for all your interaction for sharing these videos. Also, I had a commenter tell me that this channel depressed him, right? I don't want anyone to be depressed, and I wish the financial situation was better in this country, but it's all from your point of view, right? So if you're making money in the markets, you should be happy about inflation. If you're making enough money, that is to keep up with the rising cost of living, right? Most people that I know of are not making that much trading and investing to beat the cost of living. That's why I continue to look out for the average person, the average little guy. But you might be an investor that's beating the game. You might be beating inflation. I hope you are. But I just wanted to put that out there because I'm not trying to depress people. And in fact, I've got a new outro song. It's a very happy song. So please listen to the end for the outro. Also, link in below if you like to listen to the full songs that you hear at the end. Some of you don't like them. If you don't like them, then of course don't go to the link. But link down below to all the full tracks. Most of them are instrumentals. And you see this Kiss shirt, right? It doesn't sound anything like Kiss. All right, and actually, real quick before we get into the financial news update today, yeah, I listen to way too much Kiss. And if you go to that channel below that has all the songs, it'll show you like my influences, a lot of mainstream stuff, right? Hank Williams, Muse, Linkin Park, DMX, Post Malone, Metallica, Kiss, and a whole bunch more. So we'll talk about music on the other channel if you ever drop over there to say hi. All right, but back to the weekend financial economic news report. We're going to talk about the markets. We're going to talk about the bankers. We're going to talk about the rising cost of living, rising prices, and a lot more. Now, a few reports ago, we talked about, well, actually last report, we talked about good luck staying out of debt. Ford Credit Company, or Ford Motor Credit, has eliminated the credit score needed to borrow money. So that should tell you everything you need to know on the lengths that would go through, the banks will go through, to keep prices rising, to keep people getting into debt, borrowing money, buying goods. And we saw a record run up in credit cards starting just a few months ago. And it was just reported a couple weeks ago, this is out of Bankrate, that a record number of credit cards were opened in June. And it's dwindled down here a little bit in the fall. But as you can see, people are really ramping up their spending. Credit card debt took a all-time high leap during the most recent quarter. And we're seeing consumers right now buried under $930 billion of credit card debt. So coming up on $1 trillion. Right, and also just a couple reports ago, we talked about the millennials, how they're getting outbid on homes by mostly baby boomers, but also corporations coming in and buying homes. And how a lot of younger people are very financially strapped right now and having a hard time buying a home, of course, because of all the debt and the high cost of living. And as soon as you get out of high school, you're already facing, mountains of costs when it comes to just everyday basic needs. And young people have the highest credit card delinquency. If we look at this article right here, we see 18 to 29-year-olds, it's over 9.3% are delinquent on their credit cards. And the older we get, well, it's a little bit less. For example, 70 years plus is a little over 4.2%. So if you're someone that bought your home 40 years ago when things were cheap, you're going to be in a much easier financial position. Plus, older people typically don't travel as much. They don't do as much careless spending for the most part. Some of them do. But yeah, just think about that. Nearly 10% of people age 20 or age 18 rather to 29 delinquent on their credit cards. Now, here's an article here that I thought was kind of funny. Retail sales unexpectedly rise in September as consumers keep spending. Should it really be a surprise when people are running up record amounts of credit card debt and opening up record numbers of credit cards? Would it be a surprise that spending would increase? Well, of course not, right? And it's just going to continue as banks have no worries about people being able to repay this. Why? Because they have endless support from the fiat, the fake phony money system, where they can just click a mouse and inject trillions into the banking system as needed. And the printers, I say printers, technically it's just digital, so really they're not printing most of it anyways. The creators of this currency, mostly digital, have promised endless support for the banks and have said, quote, whatever it takes, unquote, to keep the banking system operational. All right, so we saw some bank earnings here just recently for a lot of the mega banks, major banks. And no surprise, the bank earnings were looking very, very good and beat expectations in many cases. And it seems like they're always looking for new ways to get people to take on more debt, including refinancing and, of course, buying homes and mortgages. But here's an article out of Yahoo, and we see Elton John. No, that's not Elton John. That's not the Rocket Man. I know the Rocket Man. That's not the Rocket Man. As mortgage rates move higher, homeowners are making a miscalculation. So they're saying that not enough people are refinancing, and they're saying that mortgage rates are going to continue to rise. Well, I kind of doubt it. Do you really think the Fed is going to let mortgage rates rise with all of the debt that's out there right now? It's very unlikely. It may move up and down a bit. In fact, let's take a look at a long-term chart here of mortgage rates and see where we stand. And here's a chart here that goes back about 50 years. As you can see, we're still near record lows. And yes, it'll bounce up and down, and it's bounced up a little bit here recently, but nothing to panic about. But if you read a lot of these articles, they're trying to scare people into getting to refinancing and to buying a home before mortgage rates rise. Well, what happens when mortgage rates actually rise significantly? Well, home prices start to come down because people can afford a less home. People can afford less home when the rate's higher. So if you're looking for a lower home price, then you'd be rooting for mortgage rates to rise. Right? I'd rather have a $100,000 home at a 10% mortgage rate, which is not likely to happen, but if it were to exist, I'd rather have that versus a $500,000 home at a 2.5% mortgage rate. Why? Because your principal, you can pay that off much faster by making extra payments. You can't do that when the principal's, $500,000, and not as easily anyways. But yeah, if you zoom in here on a 1-year chart, we see that the rates have went up a bit here. They were down in about the 2.7 range back in August, and we're up over 3% now on average for a 30-year fixed rate mortgage. So as you can see, a slight uptick, nothing to panic about. Again, the money printers, the Fed, they're not going to let rates rise because it's game over if they do. Why? Because there's so much debt right now everywhere. The country's in debt. States are in debt. Local and city governments, people are in debt. Corporations are in debt. Not all of them, but for the most part, record levels of debt wherever you look. And what's the solution for too much debt? Well, it's more debt. Right? There's even an article out here telling you why it's bad to put 20% down on a mortgage and that may be a huge mistake. So they're encouraging people to put less down on their mortgage. And what they're doing here is they're showing you over a 30-year period how much you save by putting down a larger down payment. So a 20% down payment versus a 10% down payment, you're going to end up paying more to the tune of about $30,000. Now, it can be beneficial to not do a big down payment. For example, if you take the 10% cash or the extra money that you have because you didn't do 20%, if you take that extra money and make more money on it than you pay extra on the mortgage, then it's going to pay for itself. So let's say you invested and you double your money somewhere, then it turns out to be worth it, but you have to be, of course, a good investor. A lot of people are just beating that in the stock market. They're making more money that way. So people are choosing to take on more debt so they have more cash on the side to try to make money in the markets, right? So if you have debt, you may choose not to pay it off if you're making more investing the money that you normally would use to pay off the debt, right? So crazy times. And that's what happens when you have so much debt out there that with the banking system, that's endless amounts of debt could be created. Rising prices, inflation, so people are even more scared not to invest because they see the rising cost of living, and you see your money just sitting in the bank and basically getting chewed up by inflation just sitting there. All right, let's wrap it up with the markets. Dow Jones 35,290, a increase of 382 on Friday, which was yesterday. Nowhere but up for the markets, unless somebody pulls the plug on what? The money printers. money digitizers. All right, new outro song coming. This one sounds really weird, I know, but here it is. Stay well, stay safe, keep stacking, stay prepared, stay positive, no depression. Being in front of the curve financially, it's going to make us all better off in the end. Thanks everybody for being here. Bye for now. Peace.